Hi everyone, myself Bagisha, Assistant Professor from PG Department of Commerce and Business Management, Arya College, Ludhiana. I hope you all are doing fine. Today I'm going to discuss a very important topic of financial management, that is the subject of BCom third year 6th semester, theories of capital structure. Before doing the theories of capital structure, we must know the meaning of capital structure, right? So we know that every company, every kind of business needs capital to run the day-to-day operations. The capital structure may be in the form of equity shares, it may be in the form of debentures, it may be in the form of preference shares. So basically capital structure, it is the composition or makeup of its capitalization, that how much equity contribute to it, what is the proportion of debt to it, right? And it includes all long term capital resources like loans, reserves, shares, and bonds. And there are four forms, or we can say there are four patterns of capital structure. The first one is equity shares only. Second one is equity and preference shares. Third one is equity and debentures. Fourth one is equity, preference, and debentures. Let's do the introduction of theories. So, different authors have given the different theories. Different authors had different point of views. They tried to explain the relation between the cost of capital, capital structure, and value of firm. The main contributors are Durant, Solomon, Modigilani, and Miller. And the theories they have given are net income, net operating income, traditional approach, and Modigilani and Miller approach. Now we will do all these theories one by one. There are some basic notations that are used in the theories of capital structure. Some of these notations are like E. E stands for total market value of the equity. D. Total market value of the debt. V. Total market value of the firm. Means the total market of the value of the firm includes the market value of the debt and the market value of the equity. It is a sum of debt and equity's market value. I stands for total interest payment. NOP is net operating profit, that is also called as EBIT, earning before interest and tax. NP, net profit or profit after tax, this is PAT, profit after tax. D0 means the dividend that the company has paid at time 0. 0 means at the present time, means it is a current time. Then D1 means the expected dividend at the end of the year 1. P0, current price of the share. Current price means the price of the share that is existing. Next one is P1. P1 means the price we are expecting after 1 year, like the future price, expected market price of the share after 1 year. KD is after tax cost of debt, that is I divided by D. I is your interest. KE, this is cost of equity, that is D1 upon P0. KO, overall cost of capital, that is this is also known as WACC, weighted average cost of capital. The formula for this is NOP divided by V, or we can say EBIT divided by V. V is the value of the firm. Now we will understand these theories one by one, and the first one is net income approach. This theory is given by Durant. According to him, there is direct relation between the capital structure and the value of firm. So here you can see the capital structure matters. According to him, as we use more and more proportion of debt in the capital structure, more and more debt in the capital structure is used, our overall cost of capital will decrease and the value of firm will increase, and vice versa. So you can see here, as suggested by Durant, this theory states that there is relationship between capital structure and the value of the firm. The firm can affect its value by increasing or decreasing the debt proportion in the overall financing mixing. So there are some basic assumptions regarding this approach. The first one is there are no taxes. No taxes, whether these are corporate taxes or personal taxes. KD is less than KE, means the cost of debt is less than KE, means the debt is the cheaper source of finance than equity. These are two assumptions here. So basic statement of this theory is that as the proportion of debt in the capital structure increases, the overall cost of capital will reduce and the value of firm will increase. Now the third assumption is both KD and KE will remain constant. It means the cost of debt and the cost of equity will be same. And increase in financial leverage has a change in KO, means if there is any change in KO, that is overall cost of capital, that it may be due to the change in the financial leverage. It may be due to the change in the use of debt in your capital structure. Financial leverage means how much debt you are using in your capital structure. So as the degree of financial leverage increases, KO decreases as the proportion of debt increases. So if we want to find out the total value of the firm or total income of the firm, we can calculate it as V stands for the value of the firm. So it is a summation, it is a plus, it is the addition of S plus D. S means the market value of equity plus D. D means the market value of debt. And how we will find out the S? S is equal to earnings available to equity shareholders, the earnings that are available to equity shareholders after the payment of interest, tax and preference dividend will be divided by KE. KE means equity capitalization rate, and the formula for finding out the overall cost of capital is EBIT upon V. Now, using the formulas, let's go through an example. I am going to read the statement. A company's expected annual net operating means EBIT, that is rupees 50,000. The company has rupees 2 lakh 10% debentures. The value of the debentures is rupees 2 lakh and the interest rate is 10%. The equity capitalization, that is KE of the company, is 12.5%. So how we will find out the value of firm here? See, net operating income is rupees 50,000, that is given, less after net operating income, it means it is your EBIT, earnings before interest and taxes. So first we will deduct the interest, right? So what is the amount of interest on rupees 2 lakh? It is 10% interest. So 20,000 will be the amount of interest. So the earnings available to equity holders after the payment of interest is profits after tax are rupees 30,000, that is rupees 50,000 minus rupees 20,000, as tax is not given here. So all the earnings are available to the equity holders, right? The equity capitalization rate is 0.125, 12.5% is given, so we will write it as in percent 0.125. So market value of equity, as we know the formula, that is earnings available to the equity divided by KE. KE is equity capitalization rate, so it comes 2,40,000, and the market value of debt, as we see in the statement, that is rupees 2 lakh. So if we want to know the value, total value of the firm, that is the summation, that is the addition of the market value of firm, the market value of debt and the equity, it will be 4,40,000, that is 2,40,000 plus rupees 2 lakh, right? And if we want to know the KO means the overall cost of capital, and the formula for that is EBIT upon V. V we know, that is 4,40,000, right? So 2,40,000 divided by EBIT will be divided by V, it will come like 11.36%, right? So using the formulas of V and KO, we will solve the question and we will find out the value of the firm. Our next approach is net operating income approach. This approach is also given by David Durant. So this approach is, you can say, this is totally opposite to the first one, that is net income approach. According to that approach, as we were using more and more debt in the capital structure, the overall cost of capital will decrease and the value of firm will increase. But here, according to him, there is no impact of leverage on the cost of capital as well as on value of firm. So according to the net operating income approach, he wants to say the overall capitalization rate and the cost of debt remains constant, means the capitalization rate means the KO and the cost of debt will remain same for all degrees of leverages. So value of firm here is determined by the equation, means the formula for value of firm is EBIT upon KO. So this approach is totally opposite to the first one, that is net income approach. There are some basic assumptions of this approach. The first one is the investors see the firm as a whole and thus capitalizes the total earnings of the firm to find the value of the firm as a whole. And the second one is the KO. KO means overall cost of capital is constant. It will not change and it will depend upon the business risk that is also assumed to be constant. KD, the cost of debt, is also constant. And the fourth assumption is the use of more and more debt in the capital structure increases the risk of the shareholders and thus results in the increase of the cost of equity capital. And the increase in KE is such as to completely offset the benefits of employing cheaper debt. What does it mean? Means if we use more and more debt in the capital structure, right, thinking that it will reduce the overall cost, but at some point of time it will start increasing the overall cost because the expectations of the equity shareholders will also rise and therefore the financial risk to the company will rise, right? In that case, the advantage we are having of using the cheaper source of debt, a cheaper source of finance, that is debt, will completely be set off with the cost of equity. So there will be no use, there will be no impact on the capital structure, there will be no impact on the cost of capitalization, right? These are four basic assumptions. One more assumption is that there is no tax, whether this is corporate or personal. So here the formula to calculate the value of firm is V is equal to EBIT upon KO. This is same as in case of net income approach. S will be equal to V minus D. There we did V is equal to S plus D using the same formula we have formulated. S is equal to, that is market value of shares, equity shares will be equal to the market value of the firm minus market value of the debt. Then KE means cost of equity, equity capitalization rate. We will find it by EBIT minus interest upon V minus D. V minus D means S here, market value of shares. The third approach is traditional approach. So this approach is an intermediate approach, means it is the combination, or you can say it is a midway of the NI approach. NI means net income approach, and NOI, net operating income approach. So as we know, as we have read that according to NI approach, as we use more and more leverage in our firm, more and more leverage in the capital structure, the value of firm also increases. And according to NI approach, what was that? There is no impact of leverage on the value of the firm, means there is no impact of use of debt on the value of the firm, it is constant. So this is the midway, this is an intermediate approach. What does it state? It states that the value of firm increases with increase in financial leverage, but up to a certain point only, up to a certain limit only. Means as we use the more and more in the debt in the capital structure, it will definitely increase the value of the firm, or we can say it will definitely decrease the overall cost of capital, but it is possible only up to a certain point. Beyond a particular point, the overall cost you will see will start rising and the value of firm will start declining, because it is it is so because the equity shareholders expectations will also rise. As the firm will use more and more debt in the capital structure, the equity shareholders will obviously think that the firm is prosperous, it is capable of repaying the debts, so it is using the debt. So the expectations of the equity shareholders will also rise and it will bring the financial risk to the company. So here the value of firm will start declining. So the main proposition of this theory, means what this theory wants to say, that a firm should make, there must be proper use of debt and equity, there must be a proper debt and equity mix to achieve a capital structure which may be called the optimal capital structure. Means the firm must use the debt and equity mix very wisely. The last approach is Modi Gilani and Miller approach. In short, we can say it as approach, Modi Gilani and Miller approach. So this approach is similar to NOI approach. NOI means net operating income approach, when there are no taxes. So first one is in the absence of taxes, this approach is similar to NOI approach. And second one is when there are taxes, when we assume that taxes do exist, then this approach will be similar to the net income approach. So first one, net operating income approach, when it is similar to the net operating income approach in the absence of taxes. So according to this, In the opinion of Modi, Gilani, and Miller, what they want to say that two identical firms. Two identical firms means two same firms in every respect. Like they have same capitalization rate, they have same EBIT, but if they differ in their capital structure, right? Their capital is same, capital employed is same. Say rupees 1 lakh. There are two firms A and B, and the capital employed is same, rupees 1 lakh, right? But the capital structures are different. Like firm A is your levered firm. Levered means it has debt also, right? And firm B is unlevered firm. Unlevered means it has no debt, only equity is there. So capital employed is rupees 1 lakh in both the firms, but capital structure is different. So it cannot have different market values or cost of capital. It is because of arbitrage process. So main statement is that two identical firms means the firms that are same in every respect except the capital structure, which have different market values or cost of capital. Arbitrage process will take place there. Means the investors will engage in personal leverage. Personal leverage means they will take the loan personally as against the corporate leverage, and this will again render the two firms to have the same total value. It means if the two firms are having the same capitalization rate, EBIT, means they have same business risk, but their capital structure do are different, means the capital employed is same but the capital structure is different, so they will be having the same market values and cost of capital. But if they have different market values or cost of capital, their arbitrage process will take place and their value will be same, right? This is because of personal leverage as against the corporate leverage. And when we assume that corporate taxes do exist, then this theory will be similar to net income approach. So according to that approach also, the value of the firm will increase and cost of capital will decrease as we use more and more debt in the capital structure. So it is also recognized that the value of the firm will increase or the cost of capital will decrease with the use of debt. It is so because the interest charges that we pay on the debt on debentures are allowed as deductions for the tax purpose. So the value of unlevered firm, that is VU, will be calculated as EBIT upon KO. KO means the overall cost of capital and 1 minus T after tax. So unlevered firm is that firm that is not using any debt in the capital structure, and the value of levered firm will be calculated as value of unlevered firm plus TD. TD means tax deductions on account of interest charges. So we have covered all the four theories. I hope this is clear to you all. Thank you so much. In case you have any problem, then you can contact us anytime. Thank you so much.